The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin, Jeong. Now, the oil market is shaped by a variety of key factors that influences price movements and overall stability. These include supply and production levels driven by decisions from major oil producers like OPEC Plus and non-OPEC countries, which can directly impact global oil availability. Now, global demand plays a crucial role, with economic activity, energy consumption, and industrial growth driving the need for oil. Geopolitical events such as conflicts, political instability, or sanctions can disrupt supply chains and lead to price volatility. Additionally, tariff and trade policies, particularly those from major economies like the U.S., can affect trade flows and pricing dynamics. Now, with these factors in play, how will this impact oil prices, and could oil prices be lower in 2025 than it was in 2024? Well, to find out more, joining me now is Mukesh Sahdev, who is the global head of commodity markets of oil at Rystad Energy. Mukesh, thank you so much for joining me once again.
Thank you. Good to be back again.
All right, Mukesh, oil prices rose after U.S. issued, new Iran-related sanctions, and renewed tensions in the Middle East countered, strength in the dollar. How are oil markets faring at the moment, and what's been moving markets at the moment?
Great question. I think, yes, indeed, there's lots happening on Iran. There's lots happening with Russia. And I think, we're bracing for when the U.S. opens up for what the U.S. administration is calling for the Liberation Day, which means quite a lot of tariffs coming in, into the action. But what's really happening is that despite all of these, what we have seen is the prices don't move that much, right? In a normal time, I would say prices would have reacted a lot. And the big factor why prices don't show a big volatile move is we know that we have spare capacity in the world. OPEC Plus as a group has effectively 5.8 million barrels per day spare capacity, and that balance can come online. Number one, right? We also know that China used to be a big engine of growth from a global demand perspective, but because of these tariff sanctions and sanctions on Venezuela hurts China, sanctions on Iran hurts China, sanctions and tariffs on Russia hurts China's ability to get crude oil and petroleum products at a cheaper cost. So if China is not the engine of the demand growth, then that also is reflected in the oil market. So I would say China not being the factory of the world and driving the demand growth, OPEC Plus having enough spare capacity, I think the oil prices do not move. And maybe the last factor I would add here is that all the tariffs and the sanctions which are coming from the Trump and the U.S. administration are always being viewed as a negotiation tactic rather than real one. So people stay in a wait and watch mode, and less trading happens. And that is getting reflected. The oil price is still around 74, 75.
I see. Well, some experts say oil prices are likely to be lower this year than last year, with Brent crude oil prices averaging $73 per barrel in 2025. Now, that's down $7 per barrel from 2024. Could this be a likely scenario, Mukesh?
So let's get into one very important factor, that when people look fundamental supply-demand balances, they always compare an average 24 versus average 2025, right? And if you look at the fundamentals, clearly the demand growth is about 1 million barrels per day, which is okay. On the supply side, we have the non-OPEC countries, which includes the U.S., the Brazil, the Guyanas, the Argentinas, the Norways, and the Canadas. If you add all these countries' supply growth, yes, the numbers are somewhere between 1.3, 1.4 million barrels per day. And then OPEC has also been announcing that every month we will bring close to 140, 150,000 barrels per day. So on a year-on-year basis, it looks such an infeasible state that we have quite a lot of almost double the supply coming in 25, whereas demand is not there. What is the price outcome? Prices should fall back because we have too much supply, and only prices will let the supply get corrected downwards. I think that way of looking at the market is becoming a bit obsolete because we are in a very fast-moving information and news cycle. So the right way to look at it is, don't look at year on year. Let's look at March to August. Seasonally, this is a time for demand to rise by 1.5 million barrels per day. this is the time when the global refinery system comes out of the maintenance and it is hungry for crude oil to make the products for the summer demand. That number is about 2.5 to 3 million barrels per day. And if you add up the supply from the OPEC and the non-OPEC, that number is 1.5 million barrels per day. So the year-on-year number tells the oil prices should fall. But if you look at from March to August, it's a very clear indication that the market is extremely sort of a tight mode. And this tightness is not so much reflected in the oil price, but this tightness is reflected in the time spreads, or what we call the backwardation in the market, where the prices now are higher and the prices in the futures curves are lower. So I would say, market from March to August is actually tight, and we don't believe that the oil prices will fall down.
I see. Then how do you foresee U.S. tariff policies affecting the global oil market in 2025, particularly in terms of demand and price stability?
I think excellent question, Hongbin, that, tariffs versus sanctions, I think the distinction is becoming extremely important. When you enforce sanctions on a producer of oil and a seller of oil, there is a lot of enforcement cost associated with it, right? You have to go and you have to catch the ships. You have to catch the insurance systems. What the new playbook which Trump has put on is a very smart, I would say, tariff the buyer of the oil. If you sanction or put a tariff on the buyer of the oil, automatically the seller of the oil will get curtailed. And that's what we are seeing right now, especially on the supply side. India is now not hesitating to buy Venezuelan oils. Chinese refinery, a teapot refinery in Shandong, was sanctioned because they bought an Iranian vessel. Now there is tariffs being talked on anybody who buys Russian crude oil will be tariff. And tariff is not crude to crude. Tariff is on anything. So if you attack the buyers of oil compared to the producers of the oil, it is becoming a much more potent and effective tool. And that is why at this point of time, the fear in the market is probably rising. But we don't see the oil price spike because we know OPEC Plus is ready to bring the barrels back and take advantage of it. And Trump and U.S. administration knows that OPEC Plus has spare capacity, so they can afford to do these tariffs and sanctions. So that's the supply side. When it comes to the demand side, yes, tariffs in general will spur deglobalization, and they will just increase the cost of doing business across the globe for sure because of just these levies and duties. And in that sense, yes, there will be some dampening on the demand. But the dampening effect on a demand will show up at much delayed time. But the supply impact actually shows much faster than the demand impact. So yes, China will not grow as much as they wanted to grow. India might also face lower growth because the cheap crude oil advantage from Russia is going to be, let's say, take the impact. But I believe these countries reserve enough resources to weather the present moment and try to stimulate the economy in a different way. And everybody is also hoping that probably U.S. administration cannot afford these tariffs and sanctions towards the summer because if everything remains like what is happening right now in the market, tariffs, sanctions, Iran tensions, the oil prices will go high because demand is going to go high in the summer. And then the pump prices in the U.S. will start rising. And that's where the impact will be felt in the U.S. So I guess Trump deal clock is probably ticking, and then we are in a different oil price and a fundamentals regime.
I see. Well, there are concerns, Mukesh, about the potential supply effects of a shift in U.S. policies towards Russia as well. Could you explain how this could impact the oil market?
Yes, I think it's a very evolving situation. So Russia was sanctioned, we all know, and there was a price cap put in. It was not that Russia cannot sell the oil. It was that Russia can sell the oil probably if they remain the $60 per barrel cap price. So Russia was selling huge quantities of oil to China and India. These were the biggest buyers. Some oil was also going to Turkey. Now, what has happened is that the sanctions didn't work and Russia continued to pump the barrels. We are still seeing the barrels go out. But these tariffs, India will certainly hesitate. India is buying about 1.2 million barrels per day, quite a big number, which is almost, I would say, 20% or 25% of India's consumption. China will probably stay strong. China is also buying somewhere around 1.1 on the seaborne and 0.7, so close to 2 million barrels. China will probably stay strong. India is where I guess Russian barrels would be challenged on. And if Russian barrels are not allowed to be sold or bought, then Russia will actually try to run their domestic oil refining system and starts converting the crude oil into the product side, and then it will try to sell more products to the market. So the Russian situation is actually bullish for crude oil, but bearish for the product side of the market. And what would be very interesting is, will Trump and U.S. administration go ahead and then say, well, you also cannot sell the products. Anybody who is buying Russian products made out of the Russian crude oil, they will tariff it. That's when the real crunch will come. And I guess U.S. has all the cards right now. Russia is extremely weak. So these sanctions or tariffs will result in probably getting the deal done sooner or later.
I see. Well, meanwhile, OPEC Plus is planning to gradually increase production in the next few years. How do you think these increases will impact oil prices? Will there be a major impact?
Well, I would say that the number one goal for OPEC Plus is to maintain price stability. And I think we talked last time when we spoke was that OPEC Plus and the producers have learned if they want to enjoy higher forever, as they did before the pre-shale era, they get lower for longer prices. And that disturbs the market price stability, some years 100 plus, and then some years 40s and 50s. So our number one target is to stabilize the prices somewhere around this $70 to $80 per barrel. Happens in the oil market, these disruptions. OPEC Plus has the ability to stabilize the oil prices. And maybe few factors, if I go not too much detail, but spare capacity, number one, they have the right quality of oil. Number two, also the third factor is that OPEC Plus is not just a seller of crude oil. They have become a big refiner of the crude oil within the Middle Eastern countries, and they are pumping a lot of products to the market. So if they lose some money, less money on selling crude oil, they're making a lot of good money by selling the products to rest of the world. So OPEC Plus has now quality in their side, spare capacity on their side, downstream refining strength on their side. So with that in mind, that happen across the globe, OPEC Plus will be able to either add barrels or remove barrels, and a month-on-month basis keep on calibrating their policies and keep the oil prices stable, because higher oil prices is also what they don't want, because that leads to cheating, non-compliance, disturbance of the member unity. They have learned it. So they don't want very high oil price. Of course, they don't want very low oil price. So with all the tools kit in the hand, they will be able to preserve the market stability.
I see. Well, looking further ahead here, do you see any long-term shifts in the energy market that could move the oil market away from the current dynamics of supply versus demand?
Great question. I think you're right. Nowadays, it's not just the short term. It is the fear of the future oil market, which is also affecting the present moment dynamics. And one of the biggest things which we all understand is the energy transition and how the road fuels demand will decline. So we will stay what I call in a supply inertia years for some time, where the supply correction needs to happen and supply will be higher than the oil demand for another 5-6 years or so. And the prices have to actually go down to bring the supply down. And after, let's say, 2030s or middle, then we believe that the demand might continue to be there and not fall as fast, but the supply side will fall faster than the demand side. And then we might land into a reverse price cycle where the oil prices have to increase again to support the supply because demand has not fallen too much. So I would say another 5-7 supplied world where supply corrections have to take place, then inflection point somewhere in the 2030s, and then we will be back again where we need some higher oil price to produce more oil because the demand side is not going away so soon, so fast.
I see. Well, thank you so much, Mukesh, for your time and your insights today.
Thank you. Always a pleasure.
Thank you. That was Mukesh Sahdev, who is the Global Head of Commodity Markets of Oil at Rystad Energy. This has been The Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.